From TheoTrade, this is Don Kaufman. It's July 8th, 2019, and you are watching the TheoTrade evening video. 3 minutes to go to the cash close. The S&Ps are down 11. Hey, but people, it's a little bit of a slower trading session. By that, I just want to take you over to the volume inside of the S&P futures, doing about 885,000 contracts. We'll be lucky by the cash close to see a million contracts trade. Nevertheless, just because it's slow today, don't step away from your computer, because this is going to be a fun-filled central banker kind of week. I know I'm sick of talking about the central banks as well, but we get to hear from the likes of the ECB minutes, the Fed minutes. Jerome Powell is testifying. It just goes on and on this week, which actually brings me to the reasoning for tonight's video. It's all about the financials right here, right now. And I look at the financials as being extraordinarily opportunistic, not just in the very near term, but on a longer duration. Okay, the financials being extraordinarily opportunistic. Now, one of the things that I want to bring into perspective is that the financials, we could look at all kinds of financial stocks. Listen, we could look at, JP Morgan, we could look at Morgan Stanley, we look at Bank of America. Again, we could talk financials, the city till we're blue in the face. But I'm using the XLF, which is the financial ETF. Okay, it's kind of a mainstay for all the financials, if you will. And what do financials typically need for decent upside performance? Well, a lot of the financial performance, okay, is predicated on what's going on inside of interest rates. What is going on inside of interest rates? Well, this is the last 9 months. Now, this is something I've brought up extensively. This is the TNX, the 10-year Treasury, roughly sitting, I know it denotes 20.34, but that's roughly, it's about 2% on the 10-year. And these rates have done nothing but go down. So you would think that that eventually is going to impede upon the financials. Now, if we bring this up on a little bit of a longer time horizon, over the last 3 years, by the way, we could bring this up over 10 years. In fact, I think it's worthwhile once in a while switch the time frame. Let's knock this all the way out to 15 years. What does 15 years weekly look like inside of the TNX? Again, everything from the financial crisis on forward, we look like we're going to see lower interest rates. Now, lower interest rates, it doesn't allow, the financials to get much yield spread. And that is effectively, if you think about the 10-year, at 2%, well, financials, they make money off of your money. And the lower the rates, the tighter that spread becomes. And that spread is your, for instance, million, there's the closing bell. That's your $1 million sitting in a bank account. They might pay you a nominal interest rate associated with your bank account, and they're also going to yield something above and beyond, for providing you the service, of course, of holding you that money. Now, with a substantially lower interest rate environment, we succumb to the idea that the financials, well, they could be in some dire straits, moving into the future. And it almost looks like they've rolled over. But I don't want to be short-sighted here, And I don't want you just to look at U.S. interest rates to make this assumption. One of the things I think is plausible would be to look at some key headlines. Now, these headlines go all the way back to January, and I just want to bring you into some degree of perspective over here. First of all, we have, this is all the way January 19th. This is the IMF sees the weakest world growth in 3 years as Europe slows. Again, January 2019. Bear with me here for a second. Then we come to the IMF. Again, International Monetary Fund downgrades global growth forecast to 3.3%. That was April 2019. It's all 2019. It's relatively new. Then we come to June 30th, which is IMF urges global cooperation amid, weaker growth. Wait, it's getting better over here and we're coming to IMF's, Lagarde and ECB's Draghi warn against troubling developments in the trade war. Wait for it. now, okay, Lagarde is tapped as the next president of the European Central Bank. So for those of you not aware, again, Lagarde has been running the IMF, who is screaming at the entire world. The International Monetary Fund has been screaming to the entire world, things are slowing down, things are slowing down. And you need to be aware, okay? She is incredibly dovish, okay? And the new ECB president, Lagarde, praises negative interest rates. So make no two ways about it. We're very likely, specifically to begin with in Europe, and areas of Europe are already in negative rates, to follow the footsteps of what they've done in Japan. Japan's heavily into negative rates. And here, this is a little bit one to boot. Morgan Stanley turns bearish on global stocks as challenges to growth. That's July 7th. That's literally a day old. Nevertheless, the reason I bring up the financials in this evening's video, they're going to be under duress. Why? If you haven't seen the writing on the wall, well, that was the writing on the wall. Effectively, the new head of the ECB, well, she's going to be incredibly dovish and loves the idea of negative interest rates, which is not going to be helping the financials by any stretch of the imagination. Which brings me to a few different trade ideas. You know, if you wanted to be just extraordinarily short term, okay, and you were looking for a position and saying like, all right, you know, I think that the, XLF is going to back off to a degree. That's fine. In this particular case, you would actually go about 32 days out and you would look for something like an in-out spread. That's one strike in the money, okay? Approximately one strike out of the money. Now you can go some 32 days out. It's a $2 wide spread, but you have an issue over here. And one of the issues happens to be, first of all, the financials, right, in the next 32 days aren't really even that suitable because they're only going to move about $1. And I actually wanted to bring this into kind of perspective over here. This is not, again, a stellar position in the shorter duration, okay? What might be even more reasonable, instead of using a $2 wide spread, and I rarely do this, but you could even consider a $1 wide spread. This is a $1 wide spread for a 42-cent debit. Why would I do a $1 wide spread? Because the expectations of price movement inside of the XLF are rather diminished given you have 32 days. So that's just a bearish, shorter duration in-out spread. Now, for those of you looking for a little bit more duration to me, okay, well, you could go right out. You could just short the XLF. You could short the XLF and say, bring it, and hope the XLF actually comes down. But I think a much more reasonable way to do this and a much more, effective way to do this, specifically inside of an IRA where you can't short stock, would be to come in and to purchase a very slightly in the money put. And this one's about an 87 delta. And in purchasing this put, you're giving yourself effectively a synthetic short position. Again, the synthetic short position. You're like, how's that work? What is a synthetic short? Well, when you have about an 87 delta, it means that this option, this 30 put, should move, at least for the first dollar move, up or down in the XLF. This option should be impacted by 87 cents for every $1 move in the XLF. So if the XLF cruises down to, for example, 27, you should get 87 cents of play in this option. That's kind of what the delta signifies. But by buying a slightly in the money option, again, effectively you're synthetically short, but you're not taking all the risk. Like if you just went out and shorted the stock and the stock ran up to, 35, all right, that's going to hurt, right? You sold the stock short at 28, the stock runs to 35. The next thing you know, you're upside down by what? $7. In this case, your maximum risk, okay, sustained, would be somewhere, let's call it $2.10. I think that'd be a fair price to pay between the bid-offer spread here. Your maximum risk would be $2.10, and it purchases, okay, the ability for you to have that duration. Now, even though that this is 74 days out, I don't have any intention of just holding the position for 74 days. I'm going to eventually sell the 30 put, okay, and roll that 30 put further out in time. As they start to list, for instance, October options, November options, I'm actually going to roll this put sequentially through time, okay, with, again, the logic that a lower interest rate environment, again, a lower interest rate environment is going to continually have pressure on the financials, not only here in the US, but around the entire world. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.